Yeah, today I want to talk a little bit about psychology, which is something I do in my chat room, but I rarely talk about it. I want to talk about 5 points. First of all, whenever you take a trade, you need an edge. An edge is a mathematical advantage. And that means not only taking a trade that makes sense, but more importantly, managing the trade in a way that makes sense. And without that, you cannot make money. One of the biggest problems I think that traders have, especially starting out, is avoiding bad trades. And if you've traded for a month or two or a year or two and you're still losing money, and you look back at your trades, you'll see that you took a lot of really good trades. And the key to making money is to get rid of the bad trades. And if you can get rid of those bad trades, you'll have had enough winners so that you will be a profitable trader. Another problem I think that a lot of traders have, especially early in their careers, is they tend to hold on to losers too long. And they get emotional. And they think, well, a professional would just scale in more as it goes against me and as it goes against him. And therefore I can hold and scale in. And that's really a horrible mistake. Yes, professionals do scale in, but they do it calmly and when it makes sense. Simply holding on to a loser because you're afraid to take a loss is going to result in losers getting very, very big. Another problem that traders often have, and it's related to the problem that I just said, is that they tend to take profits too quickly. For example, if you just lost 2 or 3 trades and now you finally have a small profit, a lot of traders will just take the profit just so that they can have a winner and break the losing streak. And that's a mistake. And that is not managing the trade properly. You never look back at your prior trades when you're trading. All you do is think about the current trade. And then a very common problem is that when traders start to trade well, they want to increase their position size, and they discover that they're starting to lose money as they're increasing their position size. And I'll talk about that today. And I want to begin by talking about an edge. An edge is a mathematical advantage. By the way, I do not gamble. I like Vegas, but I like the energy. I like the shows, but I personally do not gamble. So if you go to Las Vegas with $100 and you do some sports betting, you bet $50 that the Yankees will win, and you bet $50 that the Yankees will lose. You think that, okay, you're going to get out break even. Well, that's not true. You're 100% certain that one of the 2 trades will make money. There's a 50% chance that the Yankees will win, and there's a 50% chance that the Yankees will lose. But risk does not equal reward, because at the end of the game, you'll have bet $100, 50 on a win, 50 on a loss, and the casino will give you back $90, not $100. You get your $50 bet back, but only $40 for the win. And that difference is what the casino keeps to stay in business. That's the vig. So for every $100 that people wager, the casino probably pays out about $90 and keeps 10%. That's the cost that you have to give to them for them to stay in business. And there are professional sports gamblers who make money, but you have a 10% overhead that you have to overcome. So you have to be better than 10% better than average to make money. You have that overhead that you have to overcome. And that's true with trading. There's overhead as well. I want to talk about the mathematical advantage. I talked about you need an edge, and one way to look at it is with the trader's equation. And that equation is you only take a trade if the probability of winning times the reward that you would get from the win is greater than the probability of losing times the loss, the risk that you would get if you lose. If the trader's equation is positive, then it makes mathematical sense to take the trade. Now, there are several variables here. You got probability, reward, and risk. And you can lose 60% of the time. In other words, have a probability of only 40% and still make money if the reward is sufficiently bigger than the risk. What's your edge? Most traders, their edge should be going for a reward that's at least twice as big as the risk and not worry about probability. Finding high probability trades or structuring high probability trades is difficult to do. Scalpers do it. I tend to scalp a lot. But for most traders, it's too stressful, it's not fun, and it's very hard to do it consistently well. You're trading with, in general, risk that's greater than the reward. So you have to make sure you have a very high probability, and that's very difficult to do. So most traders should just look for any reasonable trade and not exit until they have a reward that is twice their risk or until the trade no longer makes sense. To make a living as a trader, you need the trader's equation to be positive, but you don't need much more. You don't have to be perfect. You don't have to worry about trying to hit home runs every day, going for big wins. Instead, all you have to do is be consistently good. What you have to do is look for reasonable trades and manage them well. And the most important point is when you're taking a trade, go in with the intention of going for a reward that is twice your risk. So a risk-reward ratio where the reward is at least twice the risk. 40% of the time, you'll get that. 60% of the time, you'll have a small loss or small win, and they'll cancel each other out. But that 40% of the time is what you need to become a consistently profitable trader. It sounds easy, but it's really difficult to do. But it's the key to making money. And that is all the edge that you need. There are other edges that you can have. For example, if you're very good at structuring high probability trades, you can take those and scalp. But for the 99% of traders, the single best edge that they can use is take a reasonable trade and then go for a reward that is at least twice as big as the risk. Here's a price chart. And let's say you have two different computers logged in to two different accounts. And let's say you've got a stock trading right here, and the stock just rallied to 205.13 right there. And let's say you simultaneously buy it at the market in one account and sell at the market in the other account. But you're going to find that the fill on your buy is at the offer, the ask, the higher of the two prices, and the fill on your sell is going to be at the lower of the two prices. And that spread here, it's 2 cents. That is the bid-ask spread. So just putting the trade on, you're already down 2 cents. Let's say the market drops a little bit more and comes exactly back up to that 205.13, and you decide to exit. Well, the account that you bought at 205.13, when you go to sell, you're going to sell here, you're going to lose 2 cents. And the account where you sold here and you place an order to get out of the market, you're going to get filled here and you'll lose 2 cents. So you again lose 2 cents. So even though you bought and sold at one price and then you exited at exactly the same price, you did not get filled exactly where you thought you were going to get filled. So that is overhead. And when you add up mistakes, slippage, commissions, computer and broker problems, the cost of setting up and maintaining an office, those all go into your overhead, and you have to overcome all of those expenses before you can begin to make money. Again, all you have to do is be a little bit better than average at picking the trades and managing the trades. You don't have to be great. You just have to be good and consistently good. Traders need an edge, okay? And the simplest edge is going for a reward that's 2 times the risk. Let's say you sold below this little doji bar and got filled right here, this red rectangle, and you put your stop up here. Risk is not particularly great. You have tremendous profit potential. So the reward is far greater than the risk. It's 3 or 4 times greater than the risk. But it's really not that high probability of trade. We have a bull breakout. We have a bull inside bar closing on its high. It's more likely that there'll be buyers below that bar and that will continue higher. So it's a low probability bet. But it's still okay because the reward is so much bigger than the risk. On the other hand, if you wait for a pair of big bear bars closing on the lows and then sell, all of a sudden the probability goes up, but your stop is either here or here. So the risk is greater and there's less reward. So the risk reward is less Whenever you wait for a trade to become a high probability trade, the risk reward is always going to be less. You cannot have both high probability and good risk reward. There has to be a reason for an institution to take the other side of your trade. If you want high probability, the institution is going to get good risk reward. You're going to get bad risk reward. Zero-sum game, you're trying to take money from very smart people. And it's subjective. I'm a discretionary trader. I don't like trading using automated systems. I've done it in the past, and I just sit here in front of my computer getting stressed out because I keep seeing reasons to override what the computer is telling me to do. A perfect trade, a high probability of making a lot of money with very little risk, cannot exist. Because theoretically, an institution is taking the other side of the trade, and there's always going to be something wrong with every trade. And no firm is going to take the opposite of this. No firm is going to take a low probability of making just a small reward while exposing themselves to a big risk. No one is going to pay $1,000 for a lottery ticket where the prize is $1, small reward, and the chance of winning is 1 in a million. Very low probability. We have a fairly tight trading range here, lots of reversals, and reward is small. You can't make much money buying or selling. So the risk reward is not very good. You get bad risk reward. However, the probability is high if you're buying low and selling high, especially if you're using wide stops and scaling in. So bad risk reward, but high probability if you manage the trade correctly. When you have a big breakout like this, you have a high probability of making money, but very often the stop is far away. So the risk is fairly big. The reward is big. So big risk, big reward, neutral risk reward, but high probability. Bear channel, the probability and reward are good. Selling in a bear trend, the probability is you'll make money, and the reward is good, but the probability is less than in a breakout. Risk can be small. If you sell below bear bars closing on their lows, right, and just put your stop above the most recent bear breakout. So average probability of making money, certainly less than the probability of a breakout, and decent risk reward. So different risk reward probability profiles for trading range, breakout, and channels. And you can take any of those trades. The math is good. Okay, I think the source of all emotion in trading is probability, uncertainty. And computers have no emotions. The market has no emotion. And you can only make money if you can get rid of your emotions or at least minimize them. 90% of bars on every chart are either in a trading range or in a channel. And when that's the case, you can buy or sell and make money if you manage the trades correctly. Only 10% of the bars on a chart are strongly breaking out to the upside, up or down. 10% of the bars on a chart, the market is in a fairly strong trend. And when it is in a trend, here we got a breakout, it's better only to trade in the direction of the trend. One way to do it is sell the close of a bear bar or sell below the low of the prior bar, especially if the prior bar is a bear bar closing near its low. Another thing is you have to be comfortable with uncertainty. Whenever you take a trade, you're always wondering, is it going to go up a little bit more? Am I going to make money? Is it going to go down far? You just have to be comfortable with the uncertainty. That's just part of the game. And that's part of the excitement. It's part of the fun. Okay, as I said, you should think of every trade as one institution buying and another institution selling. 95% of the volume in the E-mini and most stocks is being conducted by institutions. That means there's going to be one buying and one selling. The two institutions are trading probability and risk reward. Sometimes both probability and risk reward are neutral. Sometimes one is higher probability. That means less risk reward. The other side has to get something, right? So if you're taking the high probability trade, the institution doing the other side is going to be getting a good risk reward, and vice versa. Probability, 95% of the time, the probability is between 40% and 60% of anything, buy or sell. During strong breakouts, the probability can be 70% that the breakout will continue. But for 90 plus bars on the chart, at any instant, there's between a 40 and 60% chance that the market will soon go up or soon go down. Okay? Which variable did you choose? You want the high probability trade? If you do, the other side gets good risk reward. Do you want good risk reward? Then the other side gets high probability. In other words, you have low probability. You'll be more like a 40% trade. And you can get good risk reward with small risk or with big reward. So the best edge is take a reasonable trade and go for a reward that is at least 2 times your risk. And then I said it's really important to avoid bad trades. What often happens is a beginner only thinks about one variable. There are 3, risk, reward, and probability. Beginners only think about risk, and they don't want to lose money. Their account is small. They're dreaming of having a career as a trader, and if their account gets too small, they cannot meet margin requirements, and it's the death of their dream. And so beginners are always trying to buy reversals, because buying reversals, the stop is not very far away, and the result is your risk is small. For example, we're trying to reverse. You buy. Try to bull bar, buy, bull bar, buy, bull bar, buy. Every one of those trades was a loss. But a beginner takes them because they're hoping that maybe this time it'll be the start of a huge bull trend. A tight bear channel only rarely will go directly into a bull trend. The first reversal up is probably going to be minor, and the bulls will need a second reversal up to get a major reversal. But beginners don't care. They just think risk, risk, risk. I need small risk. And they'll take these small risk trades, and they all have very low probability. In other words, they're bad trades. So the beginner buys above this bar, puts a stop below, gets stopped out. Buys above this bar, puts a stop below, gets stopped out. So 4 losing trades. And he never had much reward potential because the first reversal up is not going to go all that far. So the reward is small, the risk is small, the reward is small, but the probability is very low. You're betting on a big win buying in a bear channel. That's a very low probability bet. Bad buys. You cannot make money if you're taking trades like this. So you have to stop taking bad trades. What also then happens is the beginner now says, okay, gosh, we got a breakout above the bear channel, and now we're getting a second reversal. This is possibly a major reversal that could lead to a bull trend. So the beginner then takes this trade, but he just lost 4 trades in a row. So what's he going to do after he takes that buy? He's going to say, gosh, I need a win. I'm just going to exit right here, right? After losing 4 times in a row, he's desperate for a win, and he ends up exiting with a very small profit. Cannot do that. Again, you should be going for swing trades where the reward is at least twice the risk. And as a general rule, a swing trade should last 10 or more bars. So if you're taking a swing trade and it reverses 2 bars later, 5 or 6 bars later, it's better to rely on your stop because it's probably not the end of the trend. An experienced trader, he's not buying above all those bull bars. He's selling below bear bars. So he'll sell here and put a stop up here. So he's risking a lot, but he's also going for a big reward. And the probability is pretty good. You're selling in a bear trend. So every time he sees a reversal up, he looks for a bear bar and sells below the low of the bear bar, betting that the reversal up is minor, a bear flag, and that the trend will continue. I sometimes talk about trading like Forrest Gump versus Albert Einstein. I do think Forrest Gump has a better chance of making money than Albert Einstein. You don't have to be a genius to trade well. Don't think too much. You can get paralyzed by too much analysis paralysis, right? So Forrest Gump looks at this and says, oh, it's going down. I bet it's going to go lower. I'm going to sell, right? And don't try to come up with all kinds of formulas that tell you that it's time to buy, that some oscillator is diverging, therefore you buy. It's going down, just sell. Every time it starts going up, assume it's minor. Look at a bear bar and place a stop to go short below the bear bar. That's what the experienced traders are doing. And then what we have here? I said this is a second reversal up. You can call it a lower low. You can call it a lower low double bottom. In any case, it has the potential for a swing up. All of these buys in here were minor. This could be a major reversal into a swing up. It's a lower low major trend reversal and a reasonable buy, but take it for a swing trade. Hold on to it until the end of the day or until the trend is no longer going up. And you can see the reward here is many times greater than the risk. You buy there, risk here, stop. And this is 4 or 5 times the risk. And you do that, even a big win like this, even 30% of the time, it's going to make you a profitable trader. Okay? As I said, the key to becoming a profitable trader is avoiding bad trades. So even if you don't take all of these shorts, as long as you don't take those terrible buys and you do take this buy, you'll end up being a profitable trader. So you got to get rid of the bad trades. Don't take bad trades. Look at all 3 variables, risk, reward, and probability. Don't simply look at, oh, if I take this buy, my stop is not very far, right? If you're buying in a tight channel, it's a low probability trade. Cannot do that. If you're buying a double bottom after a strong reversal up above the bear trend line, then the probability is better for a swing up. So a bull bar is not a reason enough to buy. If the market's in a tight bear channel, you cannot be buying, right? You have to look at the context. The context means the bar is to the left. So buying here, what's the context? A tight bear channel here within a bigger bear channel. So not buy. Common problem with beginners is tend to hold on to losers too long. Okay, I want to start with a disclaimer. Okay, I did not do that. That is not my frog, not my pan, not my stove. I did not do this. I stole the picture on the internet. And the point I'm making here is that frogs are cold-blooded. If you put them in a pot of water and slowly raise the heat, they will not react. They're unaware of the small changes. And there's a concept called planned continuation bias. It means ignoring evidence that your plan is no longer valid. And if you keep ignoring pieces of evidence that what you're doing is wrong, it can kill your account, right? So you got to pay attention to things that tell you that your trade is wrong. Let's say, for example, you have a bull trend. Let's say you bought here, a high 2 pullback, 2 legs down, 1, pause, 2, right? High 1, high 2. Let's say you bought that and you're hoping the bull trend continues all day. If you buy it and it starts to break out, you're going to put your stop here. When you buy it initially, you might have your stop here. But if it starts to break to a new high, you'll raise your stop to here. And you can get stopped out right here if you do not get up higher. Plan continuation bias, right? Your plan is to hold on to the buy because it's a bull trend. But if there's evidence that it's no longer a bull trend, you have to get out. For example, the market breaking below the bull trend line and you have a huge bear bar. It hits your stop, right? If it hits your stop, you get out. What some beginners do is as it's starting to fall, they think, oh, it might hit my stop and then reverse back up. I'm going to get rid of my stop and put it down here, right? Can't do that. If you see evidence that your original premise is no longer good, you got to get out. You bought a bull channel, hoping for a bull trend. This one bar, especially a bear bar and follow-through bear bar, even a bear doji, a second bar after a big bear breakout, if it has even a small bear body, is enough to make it likely, high probability that we're going lower. So if you do cancel your stop as it's forming and you get this big bear bar, you should get out on the close of the bar or below the low of the bar. And absolutely, if the next bar has a bear body, you got to get out on the close of that bear bar, because we're probably going lower. This is probably a spike, and then this is a pause, and we're probably going to channel down. So if you don't get out here, you're going to be sitting through a big bear trend. The probability is high that you're going lower. So lots of opportunities to get out. Yes, you bought here and you get out here, a loss, plus you gave back all of this, but it's reasonable. The loss is not terrible. So if you bought here and got stopped out here, you have a small loss. That's what you do. That's what experienced traders do. A lot of traders would have gotten out here. Possible wedge, 1, 2, 3, and a second reversal, 1, and then 2. Or they would have gotten out as this bar was forming. So lots of evidence that your idea of a bull trend is no longer good. So if the reason you took the trade is no longer in existence, you have to get out. Remember, stops, the purpose of a stop is really to protect you against yourself. And you're putting it there so that you'll get out. One of the problems beginners have, I think, sometimes is they move their stops. So as it's going down, the beginner cancels the stop or moves it way down here, hoping that it'll bounce and maybe he can get out, break even over here. Yeah, it just keeps going lower. And let's say the beginner put his stop all the way down below the low of the day. Now he lost from here to here, a huge loss. Instead of getting out here, small loss. Beginner, he watches it go down, another leg, and he's thinking, okay, the pros, they would get out at some point. The pros, maybe they'll get out here. And that's just totally wrong. The pros would have gotten out up here or over here, and they'd be short. And they're not looking to get out of longs here. They were already out of longs. They're short now. So the beginner thinking that he's trading like a pro by using a wide stop and holding on, hoping for a bounce, he's not. He's trading like a beginner. Okay, the beginner's thinking, okay, new low of the day. That's worst case scenario stop. I got to get out. Just like what the pros would do. That's not what the pros would do. Well, the pros might get out of their shorts because they'd be shorting, but the pros who bought here are not going to be holding long here. The pros, what they're going to see is a spike and a channel, 3 legs down, 1, 2, 3, and a lower low double bottom, slightly below that low. Whenever you have a wedge sell-off to a double bottom, you're probably going to get a reversal, a bounce, maybe to the start of the channel here, maybe up here. So the pros are not getting out of bad longs from here. They're looking to buy down here. So that beginner who let the market pass through his original stop and then he gets stopped out down here, that's not where to get stopped out. This is where to buy. So 3 legs down, a wedge, and a double bottom, common reversal. By the way, that's one of the things that causes divergence in a double bottom. Lower low, double bottom, a wedge. It's a weaker sell-off, so indicators like stochastics, RSI are less oversold, and you get divergence. Anyway, a bull, he's looking to buy a reversal up. He might wait for a second reversal here, and he would like to be buying above a bull bar. This bar has a small bull body, and he'd be buying a sell climax, looking for a couple legs up, a swing up, 10 bars or more, so 1, pull back 2. So the experienced trader is buying down here and getting out at the end of the session. The beginner who lowered his stop and got out down here was doing the exact opposite of what experienced traders will do. Experienced traders are looking to buy, not get out of bad longs. So beginners, they tend to hold on to bad trades too long. Okay, another example. We got a bull trend. I said you could buy above bull bars closing near their high. So let's say you bought above that bull bar. And let's say you did not get out up here. And let's say you held long and you got stopped out somewhere down here. Okay? A huge bar like that, it's a bear surprise. let's say you bought up here and you get out down here. My general rule is if you get a big bear surprise after a reasonable buy, you're probably going to fall for about a measured move down, and you'll probably make up your loss from up here. So if you bought here and you see this, you go short down here, you should assume that it's going to fall about as far as it did from your original entry. So if you buy, exit, sell, you'll probably make about what you just lost. I want to make one other point about this. If you bought above this high and you see 3 dojis like that, you're disappointed, right? Experienced traders are going to say, oh, this is disappointing. I'm going to get out around break even. And that's what was taking place here. More and more bulls were disappointed by every new bar forming. Here we get a bear bar, a warning bar. So bulls are very disappointed if they bought here. They'll place a limit order to get out around their entry. On this little bounce, the bulls will see that and they'll get out, break even. So experienced traders will be getting out up here. But if you did buy there and held through this, you could sell down here, expecting that whatever you lost, you'll make up on the downside. Okay, so you bought up here and you get out, let's say on the close of the follow through bar, the bear bar after that bar, you'd expect it to fall for about as much as what you lost on your long. Traders who do the right thing, they tend to make money, right? The market tends to reward people who do reasonable things and manage their trades well. Taking profits too quickly, common problem for beginners. I talked about this earlier. We have a lower low major trend reversal. Major trend reversal. We had a bull break above the bear channel. If we get a second reversal up, there's a 40% chance you'll get a swing up where the reward will be at least twice the risk. So this is potentially a major reversal. And therefore, you don't want to be scalping out and taking a quick profit. I'll pull back to the moving average. Maybe we'll get another leg down. No. If you're taking this buy, you're putting a stop below the low of the bar, and you hold until there's a reasonable evidence that you're wrong. Maybe you get out below here, but with these 2 big bull bars, my inclination would be to rely on my stop and see if we go up higher. It's very common in a trend reversal that the market will do something within the first 10 bars to make you think that the bear trend is resuming. But remember, you're looking for both 2 legs, 1, 2, and 10 or more bars. This is not 10 or more bars. So chances are this is going to be a bear trap, trapping bears into a bad short, trapping bulls out of a good long. So if you're able to just rely on your stop and hold and hope that you get a big move up out of it. I have a suggestion. If you do buy above that and you're always taking a quick scalp profit, there's something I call my Walmart strategy. What you do is you take the buy, you see where the stop belongs, so you put a stop here, and you want a reward that's at least twice your risk, so you place a limit order to get out with a reward that's at least twice that risk, or you just come back in an hour and see where the market is. If your stop is not hit, maybe the market will be up here, and then you can get out at the end of the session. So Walmart strategy, if you're taking profits too quickly, if you're scalping trades that should be swing trades, just place your stop and have it OCO with a profit-taking order 2, 3, 4 times greater than your risk, and then go for a walk, go for a jog, go to the gym, go to Walmart, and then come back after an hour. Force yourself to stay out for at least 30 minutes, an hour or so before you come back. And you'll find that at 40% of the time, you'll be making at least twice your risk. I think it's a profitable strategy. So if you buy here and your risk is below that, 2 times your risk is up here. So you take that buy, you put a stop here, you place an order, cancel order to limit order to get out up here, and then go to Walmart, and you come back at the end of the day, and you say, I made twice my risk, and that's a very big profit. That's a very good trade. In general, if you're taking a reasonable major trend reversal trade, 40% chance you're going to get a reward that is at least twice your risk. I mentioned that it's very common, 60% of the time when you're early in a swing trade, the market will do something that makes you think the old trend is resuming. So you can either rely on your stop or get out below the bear bar and then look for a bull bar and buy above the bull bar for a resumption of the bull trend. A common problem that people have is they start trading well and they want to increase their position size. When they start to increase their position size, they start to lose money. And they think, oh my gosh, I'm trying to do exactly what I was doing last week when I was making money. And now that I'm trading 2 E-minis instead of 1 E-mini, I'm losing all the time. And that's because you're thinking about money. You're thinking about risk. You're just like a beginner. You're back to worrying about risk instead of thinking about the whole package, risk, reward, and probability. Until you get to the point where you can not focus on risk, it's really hard to make money. Okay. And one of my solutions, I talked about the Forrest Gump trading. I talked about the Walmart strategy. And a third thing is trading the I don't care size. Trade a smaller position size so that you really don't care if you lose money. So if you're trading 1 E-mini contract and all you're doing is sitting there paralyzed, afraid of losing money, then trade a micro E-mini, 1/10 the size. I know you're not going to get rich trading 1 or 2 micro E-mini contracts, but what you will get is practice doing the right thing, not worrying about money, and instead looking at the entire trade and managing it correctly. Everybody wants to get rich, right? And if you're starting to win consistently, of course you want to increase your position size. So let's say you're trading an E-mini and you're consistently averaging 2 points profit a day, and you're taking maybe only a couple trades a day, then you're making $20,000 a year. And instead of trading one contract, this is trading one contract, let's say you increase it to 5 contracts, not much more. Instead of $20,000 a year, you make $100,000 a year. And let's say you increase it to 10 contracts, and instead of 2 points, you're averaging 4 points a day. Now you're making $400,000 a year. Those are not big steps. I mean, they're big psychologically, but if you're a consistently profitable trader, you can make those steps inside of a couple of years. You can have a very good living doing it. But if you find yourself losing money every time you increase your position size, it can be really frustrating and really upsetting. Let's say an experienced trader makes 1 to 2% based on his account every day. Okay. And there are 200 trading days a year, about, maybe a little bit more. If you take vacations, maybe a little bit less. If you're making only 1 or 2% profit per day, so if you have a $10,000 account, 1% is $100, 2 points in the E-mini. That is not unreasonable. If you make only 1%, 2% a day, your account size will triple at the end of a year. And at the end of a year or two, a small account can be a medium account. And a few more years trading, all of a sudden you start to have a pretty good size account. Okay? The goal is to become consistently profitable and slowly grow your account. And a good way to do that is trade the I don't care size. If you increase your position size, let's say you trade 2 micro E-minis and you increase to 3 or 4 and you're starting to lose more often, go back to 2. And do not increase until you can trade as comfortably as you did before. There's always going to be a little bit of stress, but as long as you're reasonably comfortable and as long as you're not focusing on money, you can gradually increase your position size. It takes a few years to get from a small account to a decent sized account where you can trade 1 or 2 E-mini contracts. But once you're there, it can be life changing. It can be pretty dramatically life changing pretty quickly. I began by talking about needing an edge, a mathematical advantage. And the single best edge that people should consider is going for a reward that is twice the risk. Right? There are other things you can do. Good scalpers can go for high probability. For most traders, they should simply look for a reasonable trade, see where the stop goes, and look to take part or all of their profit at 2 times their risk. And then the single most important thing, I think, is avoiding bad trades. If you look, let's say you've been trading for several months and you've taken 100 trades, and you'll notice that you've probably taken 10 or 15 really pretty good trades, and you probably took 30 or 40 really stupid trades. And if you can avoid the bad trades, you'll find out that you're already making enough money to be consistently profitable. You got to get rid of the bad trades. Another problem, holding losers too long, in denial. Market's going against you. You don't want to take the loss. Small losses grow quickly into very big losses. So it's better just to take the loss and then look for the next trade. People who do lose a lot, they tend to take profits too quickly. Beginners tend to take profits too quickly. They tend to think, oh my gosh, I finally have a winner. I got to take my profit. And that's that Walmart strategy that I talked about. Place your stop, place a limit order so that the reward is twice your risk. And if you have to, go out and take a walk for 30 minutes, an hour, go to the grocery store, the Walmart strategy. And then finally, if you find that you're losing money when you're trying to increase your position size, be patient, all right, and make sure that you're always trading the I don't care size. So you want to be trading small enough so that you really don't care if you lose. And that I don't care size will increase over time. And within 2 or 3 years, you might find that you're trading a really decent sized position and you're making a pretty good living as a trader. And Terry, if you have some questions that you can read, I can answer some questions.
Give me a second and I'll go through them. On a trading range day, how do you look for areas where bulls or bears might be taking profit, say 1 to 2 times the risk, and use this information in addition to the price action that develops, maybe a strong reversal bar, in order to take a trade in the opposite direction?
Whenever the market's in a trading range, nothing feels right, nothing looks right. The bars, you get bad looking buy signal bars, bad looking sell signal bars. Sometimes the buy bars are too big, so you're forced to buy up in the middle. The sell bars are too big, you're forced to sell down in the middle. And you don't want to be taking trades in the middle. You want to be taking profits in the middle. If I'm being forced to buy in the middle, I typically don't do it unless I'm buying in a very strong leg up. I want to be buying in the bottom third, and I want to be taking profits or selling in the top third. I typically don't buy in the bottom third and then hold for a swing up to the top third. If a trading range is, let's say, 5 or 6 points tall, I might try to buy in the bottom third. I might scalp out with 1 point, 2 points. If the trading range is 10 points tall, I'll be going for 2-point scalps. So I want to buy in the bottom, sell at the top. And if things are not clear, I'll often wait for a micro double bottom to buy at the bottom or a micro double top to sell at the top. But one of the things in trading ranges is you have to assume that everything is bad. Nothing looks right and nothing goes as far as you want it to go. The market tends to look most bullish at the top. You should be thinking about selling, not buying. It tends to look most bearish at the bottom. You should be thinking about buying, not selling.
Okay. What do you recommend? Exit when disappointed by consecutive bars, or rely on a price action stop?
Everyone's default should be to rely on a price action stop. So if you're buying at the low and you're buying a reversal up, most traders should just put a stop right below the low. And you can also use money stops, let's say $100 or 2 points or some other thing. But if ever I'm in a trade and the market is, let's say I buy, and the market's going up and it has not hit my stop, but it's doing something to make me think that the trade is no longer valid and that, in fact, an opposite trade is setting up, I will get out. I don't want to let my stop get hit, especially if my stop is far away. Let's say I buy and the market has rallied for 7 or 8 bars. I really am not going to let my stop get hit. I'm going to get out before it gets hit. So I'll get out below a bear bar closing on its low or a micro double top. Or if there's a big bear bar reversing down strongly, I'll get out on the close of that bar or below that bar. So ideally, you don't want your stop to get hit. You want to be getting out with a limit order at your profit target or on a reversal down, but before your stop gets hit.
Okay. Yes, hi, Dr. Brooks. Thank you for the webinar. What are your thoughts on traders using order flow, tape reading, footprint charts, etc., to improve their entry price?
Personally, I don't like. There are people who do it. I played tennis up here, and there are 2 young guys. I say young; they're 40 years old, and that's how they trade. To me, I don't like that because I feel like I'm not connected to the market. It's working too much under a microscope. Also, I would not try to make life complicated. I would either trade using order flow, which I would not do, or using price action. I think that is the better way to trade. I think using order flow is kind of a depressing existence. I've tried it. It's just, I feel like I'm not really a player. I feel like I'm not really part of the market. And I like seeing prices going up and down and patterns forming. I enjoy that. But I would pick one style of trading and not try to combine them. I would pick one chart, one time frame, one market if you're a day trader. Just specialize in one thing and don't worry about everything else. So if you're trading the E-mini, for example, don't go looking at the NASDAQ. Don't go look at the cash index. If you're trading a 5-minute chart, don't go look at a 1-minute chart or a 60-minute chart. Just trade the chart that's in front of you. And indicators, I don't use indicators because I can see what the market's doing. An indicator, I've written all kinds of indicators, and they're based upon the bars. I don't need to look at the indicator. I can look at the bars, and I know what the indicators are doing. So I just keep it simple.
Okay. He says, what do you do when the 2 times actual risk becomes greater than your original profit target? Exit at the original profit target or the 2 times actual risk?
It depends on circumstances. Let's say you buy. Let's say the buy signal bar is pretty small, so the risk is small, but the context is very good. The resistance is, very far above. In that case, I'm not going to be getting out at 2 times risk. I'll look to get out at resistance, a test of a prior lower high, for example. For me, it's not hard and fast. On an average trade, an average pattern, I might get out 100% at 2 times risk, or about 2 times risk. But there are circumstances, if you have a really good setup and you're expecting a really big reversal, it's better just to use price action exits. You just hold until the market gets near resistance or reverses near resistance and then get out.
Okay. How much time outside of the U.S. session do you spend watching the markets? And what activities do you recommend for a trader when they're not actively trading?
For me, I'm here. I've probably watched more ticks than anybody in the universe. I've been doing this for almost 35 years, and I've watched pretty much every tick for 35 years. And also, a lot of times when I'm on vacation, I have my computers with me, and I'll trade for a couple hours or so. I like trying to see if I can pay for the entire vacation when I'm on vacation. And I remember years ago when I was young, I would trade 1-minute charts or tick charts based with a small number of ticks. And I could never understand how someone could sit there and watch a 5-minute chart all day. And then about 20 years ago, I started to realize that a 5-minute chart has an incredible amount of information going on. And on every tick, there's something to think about. So for me, today, I really like watching the market tick by tick. If you don't have that kind of a personality that you want to sit there all the time, what you can try to do is anticipate turning points or anticipate where pullbacks will end and the trend will resume. And as far as what to do in the meantime, I had a friend that I traded with online about 20 years ago, or maybe 15, 20 years ago, and he used to watch movies. So he'd sit there trading all day long, and he'd be watching a movie. He'd keep looking at the chart, looking for setups, and then when a setup is starting to set up, he'll pause the movie and then take his trade. But I don't have an answer, what to do while waiting. I know I personally sometimes will go to news sites and read news. If it looks like the market's in a very tight range and I don't want to trade it, I might read news stories. But I'm always keeping my eye on the chart. So I'm probably not answering your question the way you want, but I think if you're a trader, you have to be looking for trades. You don't have to watch every tick, but it's good to keep the screen up and look at it occasionally, trying to anticipate things before they get started.
Okay. How do you approach the task of increasing your trading size? Do you regularly increase it or do something else, or have you been at a certain trading size for several years?
I had a friend that I traded with who was a very good trader years ago, and I traded with him. I traded with him online. I never met him, but he and I traded together every day for years, and we talk occasionally on the phone. And he was a very good trader. He used to trade 4 immediate contracts. I don't know how many points he was averaging a day, maybe 15 or 20 points a day. I used to get frustrated with him and said, I'd call him and say, why aren't you trading more? You're making 4. What happens if you trade 100? You'd be making, $10 million a year. He said, Al, I make plenty of money trading this size, and I'm happy, I'm relaxed, and if I increase my size, I'll be stressed out. I don't need that, and I'm already making enough money. That's pretty much my answer. So I'm comfortable with what I'm doing right now. And if I was 30 years old, I probably would open a hedge fund and manage money. But where I am right now, every day I'm happy. I love being in front of the screen. I love trading. I love seeing things unfold. I'm happy, and I don't want to add stress. I have a lot of accounts. I don't know if maybe I have 10 accounts, and I could greatly increase my position size, but trading would not be fun. So at some point you say, I'm making enough money doing what I'm doing. I don't need the stress. But as I said, if I was 30 years old or 25 years old, something like that, I'd want the stress. But that's not where I am at this point in life. I could retire right now and I'd have a very comfortable life. But I enjoy what I'm doing, and I don't want to add something to what I'm doing that would create stress and make my life less fun.
Okay. So we're getting long on time, so we'll make this the last question. He says, do you ever check when the news announcements are going to happen during the day? I see that these news announcements can make the market move suddenly in the 5-minute chart and take us by surprise.
30 years ago when I started trading, news announcements just dominated the trading. It was horrible. Back then, you had to call in your order. You could not place your order online. So you pick up the phone, you dial the phone. Speed dial was a great advance. So you get speed dial, you call the broker. The broker writes out a ticket. So I want to buy at the market. The broker writes out a ticket. He hands it to another guy called a runner. The runner runs to the pit, hands it to a third guy in the pit, the guy flashing his hands, trying to get the thing filled. He gets it filled and gives it back to the runner. They write down the trade. They give it back to the guy on the phone, and the guy on the phone gives you the fill. I'm sorry, I lost my train of thought. Read the question again so I'll make sure I'm answering it correctly.
I was talking about news. Do you pay attention to what news come out there today?
One of the issues with news is back then, the guys on the floor had a huge advantage. They see the news instantaneously on the boards. Here I am having to go through all these steps to get a fill. And now everything is done electronically. And if you're trading on the floor, I think you're at a disadvantage because you cannot see the big picture. You cannot see the charts. You can see the momentum of the past few seconds, but that's it. News, I don't pay any attention to news now, except for one thing. Tomorrow at 11 p.m. Pacific time, FOMC announcement comes out. So usually If there's some obvious big news event, I will stop trading. Sometimes FOMC minutes can move the market. Also at 11 o'clock Pacific time. So for tomorrow, while I think of it, I think it's good to get out of any day trades before the report comes out, 10 minutes before, 30 minutes before, and not trade for the first 10 minutes after the report comes out. The reason I say not for 10 minutes is 70% of the time, in the first several minutes, the market makes a big move up and a big move down. Either one can come first, right? But after an FOMC report, 70% of the time there's a big move up and down, and you don't know which one will win. So it's very easy to get whipsawed into big losses if you trade right away. So I would wait for 10 minutes, at least 10 minutes after the report comes out to place your trade. But beyond that, 7 o'clock Pacific time, there's often some kind of a news event or a report, and a lot of times you'll see a big move on the 7 o'clock bar lasting a few seconds. I don't pay any attention to that now. I mean, I pay minimum attention to 7 o'clock. I tend to be more careful placing a trade at 6:59 and 58 seconds, because in the final second or two, that bar right before the report can start to move quickly. Beyond that, I don't pay any attention to news. And if there's a big move up or down, there's news, right? And people are going to say it was caused by the news. I don't care. And if there's a report coming out, FOMC report, I don't care what the report is. All I care about is whether the market's going up or down. So I never look up at the time I'm trading. I never look up to see what the news is that made the market move. If the market's going up quickly, I'm buying. If it's going down quickly, I'm selling. I don't care what the reason is. All I care about is Forrest Gump. It's going down, I better sell. It's going up, I better buy.
Okay. Thank you for the webinar and information and for spending some time with us even now.
I appreciate it, Terry. Thank you for having me, and I appreciate everyone listening in. I want to thank Big Mike as well.